Assalamualaikum and welcome to our group presentation. First thing first, this slide showcases the clear evidence as our group assignment and how we structure our collaboration for this accounting information system project. As you can see, on the far left, our foundation began with thorough research. We utilized academic and industry relevant sources like this AAPC article on revenue cycle management to ensure our understanding core concept was accurate and grounded. Next, in the center is a snippet from our WhatsApp communication. We use this platform to delegate our tasks evenly, tracking our progress across the 4 basic revenue cycle activities, which is sales order entry, shipping, billing, and cash collection. Finally, on the right, we use CapCut to edit and compile our individual video contribution into a cohesive and professional presentation. This factor of research, communication, and structure editing is what truly brought our group project together. Next, as shown in the top section, we use Canva as our main presentation and design hub. It allows us to creatively format our text, organize our slide, and keeping our overall project visually engaging and clean. For the technical side of our assignment, we utilize Lucidchart, which you can see showcased in the bottom section. Lucidchart is a specialized cloud-based diagramming application that is perfect for mapping out complex business processes. We specifically use its built-in data flow shapes, connectors to build our data flow diagram or DFDs. This tool made it incredibly easy to map out exactly how data moves through revenue cycle from the initial customer order all the way to the collection cash. And now I will be explaining our DFD. The entire manufacture cycle is initiated at the very top with process 1.0, which is prepare master production schedule MP or known as MPS. This planning stage relies heavily on external data inputs. On the left, the sales department feeds customer order information into the process, while on the right, the inventory file provides current metrics regarding the inventory of ready-made clothes. Process 1.0 synthesizes this demand and supply data to generate a finalized production timeline. This MPF information is then written directly into our first major data file store, which is MPS file. Once the scheduling is locked in, we move down to process 2.0, which is prepare bills of materials, which is known as BOM. This process reads the newly created MPS information to calculate the exact information breakdown of materials, part, and sub-assemblies needed for the production. The resulting specifications are logged securely in the BOM file data store. With the required material list established, the system advanced to process 3.0, which is dictates authorization. Here, the system prepares 3 copies of material requisition form to ensure tight internal control across different operational areas. Let's trace where these 3 distinct copies travel. The first copy is sent to the lab, which is stored permanently in the material requisition file for audit tracking. Next, the second copy is routed to the purchasing department, allowing them to order any additional materials required to fill gaps in the master schedule. The third copy is delivered to the storeroom department, serving as the official authorization to release new raw goods. Next, this brings us to the operational execution phase at process 4.0, begin production of ready-made clothes. This process receives the physical material directly from the storeroom alongside any supplementary material flagged by the early purchasing loop. The raw textiles are now actively cut, sewn, and assembled on the factory floor. While the physical work is happening, the system must simultaneously track labor costs and operational time. This brings us to the process 5.0, which is prepare job time tickets. This process accounts for the exact labor hours dedicated to the manufacturing batch. A copy of job time ticket is routed externally to the accounting department, which is crucial for variance analysis, payroll processing, and accurate product costing. And finally, the completed goods will flow into process 6.0, which is complete and packing. Here, the item undergo final quality checks and wrap, as noted by the data flow line at the bottom. The goods are packed individually and stored in designated containers. The physical items and concluding data flow exit the production line entirely and are transferred to the final destination, which is the warehouse, where they await shipping and distribution to customer. Through this structured process, Yasas Textile ensures complete visibility, clear division of duties, and tight inventory management across its entire manufacturing footprint. Thank you. That's all from me.
Assalamualaikum and hi. So right now we are going to explore a critical component of the transaction cycles, which is the revenue cycle, focusing deeply on its first 2 basic activities, which is the sales order entry and the shipping. So let's begin. So our first main activity is sales order entry. In a modern accounting information system, this step is triggered when a customer order is received, creating a vital source document known as the sales order. To ensure a maximum accuracy, modern systems implement strict data validation controls right at the input stage to prevent human error. Before an order can proceed, the system executes two critical automated control processes. First, it performs a credit authorization check by evaluating the customer's credit limit against current accounts receivable balances. Second, it verifies inventory availability. Thanks to real-time posting, inventory levels update instantaneously, allowing the system to accurately determine if items are in stock or if a back order needs to be created. So this complete electronic sequence creates an unalterable transaction audit trail. Moving on to our second core activity, shipping. Once the sales order entry phase is fully authorized, the AIS automatically generates and forwards a picking ticket to the warehouse team. This ticket tells the warehouse staff exactly what items to pull from the shelves. From an internal control perspective, a robust system relies heavily on the segregation of duties. This means the person entering the sales order cannot be the same person physically handling or shipping the goods. When the item reach the loading dock, they are physically verified against a packing slip, which itemizes the shipment, and a bill of lading, which is the legal contract with the carrier. So this physical verification acts as an essential secondary control process to guarantee accuracy. Once shipped, the transaction is locked, leaving a clear audit trail for the billing department to reference. In conclusion, by seamlessly linking sales order entry and shipping through an integrated digital platform, organizations maximize operational visibility while tightly safeguarding corporate assets. Enforcing real-time data flow and strong automated internal controls ensures accurate reporting and efficient business processing. That concludes our deep dive into the basic revenue cycle activities.
Well, for billing is represent the crucial transition from physical inventory movement to the formal recognition of revenue and account receivable. In a professional eyes, this process serves as an essential internal control game. The three-way match is the cornerstone of this process. It acts as a procedural safeguard against unauthorized billing and inventory shingerage. By reconciling the sales order, which document the authorization to sell. Second, the shipping document, which provide evidence of the physical transfer of goods. And the customer invoice, which represent the financial claim. The system ensure that, well, the first one is existed. The revenue recorded actually corresponded to good physically delivered to a customer. Second, we have accuracy. The pricing, quantities, and terms on the invoice match the original authorized sales agreement, preventing billing errors that lead to customer disputes. And the third one we have completeness. All shipped goods are captured in the accounting records, preventing unbilled inventory. When these documents are not reconciled, the organization is vulnerable to billing gaps or over-invoicing, both of which erode financially integrity and damage client trust. A well-designed IS automates this match, flagging any discrepancies such as a quantity shipped that differs from the quantity ordered. For immediate management, review before the invoice is finalized. Now we move to cash collection. Cash collection is the final settlement of the revenue cycle, and its primary objective is the secure conversion of receivable into liquid assets. From a control perspective, this activity presents the highest inherent risk of asset misappropriation, making the segregation of duties a non-negotiable principle in ICE architecture. The internal framework mandates that the individual with physical custody of assets, which is the person receiving cash or checks, must not have access to the accounting records. The acknowledge this separation ensures that no single individual can steal a payment and subsequently adjust the records to hide the loss, like a common fraud technique known as lepping. Kindred IS enhance the process by the first one is immediate recording, using remittance advices or logbook system to ensure that payments are logged the moment they are received. The second one is independent reconciliation, ensuring that the bank deposit slip
prepared by the person receiving cash is independently reconciled against the AR update performed by a different individual. And the last one we have timely deposition, mandating that all cash receipts are deposited intact daily to minimize the opportunity for theft or unauthorized usage. In summary, the billing and collection phases are not merely operational steps. They are the financial checkpoints where the company's accuracy and asset security are validated. By integrating these processes into a centralized act, management can enforce this control systematically rather than relying on manual human intervention, which is inherently prone to oversight and exploitation. Go!
The first weakness identified is that the sales orders are not pre-numbered, and the sales clerk manually assigns the document numbers. This creates a significant risk because documents can easily be lost, duplicated, or even manipulated without being detected. As a result, the company may record incomplete or unauthorized sales transactions, making it difficult to monitor the accuracy and completeness of sales record. Furthermore, this weakness increases the risk of fraud, since missing sales orders may go unnoticed. To address this issue, the company should implement a computer-generated pre-numbering system for all sales orders by assigning sequential numbers automatically. Every sales order can be tracked efficiently. In addition, management should regularly review the numerical sequence to ensure that no documents are missing or duplicated. This control will strengthen document accountability, improve record accuracy, and reduce the risk of fraud and errors. The second weakness is the lack of authorization and inventory check before processing customer orders. This exposes the company to several risks. Without proper authorization, sales may be approved for customers who exceed their credit limits or have poor credit histories, increasing the risk of uncollectible account or bad debt. In addition, failing to verify inventory availability before processing orders can result in stock shortage, order cancellation, delayed deliveries, and dissatisfied customers. These issues can negatively impact the company's profitability and damage its long-term customer relationship. To minimize this risk, management should require credit approval and verify inventory availability before any customer order is processed. Furthermore, the company should implement a perpetual inventory system integrated with barcode or RFID technology. This allows inventory records to be updated in real time, improve inventory accuracy, and enhance overall operational efficiency by ensuring that only available products are promised to customers. The third weakness is that the sales clerk verbally instructs the warehouse shipper to issue the goods. This practice creates several risks because verbal instructions are not supported by any documented evidence. As a result, miscommunication may occur, leading to unauthorized shipments, incorrect quantities being dispatched, or even the wrong item being delivered to customers. Without proper documentation, it is also difficult to trace transactions and identify errors, which may affect inventory accuracy and customer satisfaction. To address this weakness, the warehouse should release goods only after receiving properly authorized source documents, such as an approved sales order and a picking ticket. In addition, the warehouse should reconcile the shipping document with the sales order before dispatching the good. This ensures that the correct items and quantities are shipped to the right customer, while also strengthening internal controls and improving the accuracy of the shipping process.
Okay, so rule number 4 is the billing officer is responsible for both managing customer collection and updating the account receivable. The weakness in this process is the lack of segregation of duties. This is because the same billing officer is responsible for the collecting customer payment and updating the account receivable record. As a result, the officer may misappropriate customer payment and manipulate the accounting records to conceal the fraud. The company should separate these responsibilities by assigning different employees to handle cash collection and maintain the record of the account receivable. In addition, regular independent reviews and reconciliation should be performed to detect any errors or fraudulent activities. Number 5 is the billing officer verifies payment only by comparing invoice with sale orders without reviewing the shipping. The weakness here is that the billing officer does not review the shipping document before verifying customer payment. This increases the risk that payment may be processed for goods that have not been shipped or that shipment errors may go undetected. Consequently, this may result in inaccurate billing records and customer disputes. To reduce this risk, the company should implement a three-way matching procedure by comparing the sale order, invoice, and shipping document before processing any payment or updating the accounting records. This ensures that the transaction is complete, accurate, and properly authorized.